The world looks more dangerous by the hour. Oil jumps, headlines scream, maps light up, and fear spreads fast. You bought gold or silver for exactly this kind of moment. So why does your screen look worse when the news looks worse? And why do the biggest mistakes usually happen right here? If you like the kind of market story that only starts making sense after the headlines stop shouting, stay close to this one, because the next few minutes can save you from reacting at the exact worst time. What feels broken right now may not be broken at all. It may just be moving through a stage that most people never learn to recognize, and that blind spot is expensive. A lot of investors are carrying the same private frustration. They did the responsible thing. They bought the asset that is supposed to help when trust gets shaky, when governments overspend, when currencies get stretched, and when war enters the picture. Then the crisis arrived, and instead of relief, they got confusion. That confusion matters because confused people do one of two things. They either dump their position and call the whole idea a scam, or they double down for the wrong reason and at the wrong moment. Both choices come from the same mistake. They think gold and silver move because of fear alone. But markets are not driven by fear in a simple way. There is fear of war, fear of inflation, fear of recession, fear of missing yield, fear of being wrong in public, and fear of losing liquidity. Those fears do not all pull money in the same direction. Sometimes they fight each other before one finally wins. That is the hidden engine almost nobody explains clearly. In the first burst of a geopolitical shock, money does not ask, what is the purest safe haven? It asks, what can I hold right now that pays me, stays liquid, and feels safest for the next few months? That short-term question changes everything. Start with energy. When a conflict threatens supply routes, oil can jump fast. When oil jumps, people do not just worry about gas stations. They worry that higher energy costs will spread into transportation, food, factories, and almost everything else. The moment that fear spreads, markets stop daydreaming about easy money. Rate cuts get pushed further away. That means central banks are less likely to lower interest rates soon. And when rates stay high, government bonds keep looking more attractive than an asset that does not pay income. That is pressure point number one. Pressure point number two is the dollar. In a global scare, large pools of capital often run toward dollar-based assets because they still see them as the deepest pool in the room. When the dollar gets stronger, gold priced in dollars often gets pinned down. Then comes pressure point number three, and this one hurts the most because people rarely see it happening. Big institutions under stress do not always sell what they dislike. They sell what they can sell. If they need cash, they may unload profitable positions, protective positions, even positions they still believe in. So now you have three forces leaning on gold and silver at once. Higher expected inflation keeps rates up. Higher rates support bond yields. And demand for dollar liquidity makes the currency stronger, while forced selling adds extra weight. If you want market breakdowns that tell you where the trap is before the crowd falls into it, that is exactly what this channel is built for, because this is the part that keeps ordinary investors from getting shaken out. The drop does not mean the original reason for owning hard assets disappeared. It often means the market is dealing with a different emergency first. Protection gets delayed, not canceled. Think of it like a building during a fire alarm. Everybody knows the safest goal is to get out, but in the first seconds, people do not move in perfect order. They jam the exits, grab what they can, and create chaos before direction returns. Markets do something similar. The first move after a shock is often messy, crowded, and emotionally loud. The clean narrative comes later. That is why people who expect a straight line from bad news to higher gold prices keep getting blindsided. History has been almost rude about repeating this lesson. Different decades, different wars, different leaders, same human behavior. The first wave is often all about liquidity, policy expectations, and the dollar. The later wave is where the deeper inflation and trust problem starts to matter. You can see versions of it from the oil panic of the 1970s to the tensions around the Gulf to the years after the attacks in 2001, to the commodity spikes that followed newer conflicts. The details changed, the costume changed, but the script underneath kept rhyming. First comes the shock, then comes the disappointment. Then comes the slow realization that the old system now has a bigger problem than people first admitted. And only after that does gold begin acting like the asset everyone expected at the start. That delayed response is what creates the cruel emotional swing. At the exact moment people most want reassurance, the chart gives them doubt. And doubt, not danger, is what usually pushes them out. They do not lose conviction because the thesis is dead. They lose it because the weight hurts. If you are still here, ask yourself one question. Do you want the obvious move or the move that becomes obvious only after it has already left most people behind? Because the second one is usually where the real money lives. And that is why the next piece matters more than the war footage or the daily price noise. The setup today is heavier than the setup in many past cycles. This time the problem is not just conflict. It is conflict landing on top of a system already bent under debt, deficits, and policy limits. That changes the size of the eventual response. A weak bridge does not need a massive truck to crack. It only needs one more load. Governments are carrying debt levels that would have looked absurd in earlier eras. That means high interest rates are not just painful for households or businesses, they are painful for the state itself. The longer rates stay high, the more expensive the whole machine becomes to finance. That matters because central banks do not operate in a vacuum. They talk tough about inflation, and sometimes they need to. But there is a point where defending the currency with very high rates begins colliding with the cost of keeping the fiscal system standing. That tension is not small anymore. It is huge. At the same time, official buyers around the world have been adding gold in serious size, not because gold is exciting, but because trust is changing shape. Countries that watched reserves get politicized or frozen learned a harsh lesson. An asset nobody else can print starts to look less old-fashioned and more strategic. That shift is deeper than a normal investment trend. It is not just hedge funds chasing momentum. It is reserve managers, long horizon buyers, and institutions thinking about what can still count as neutral collateral in a less cooperative world. When that kind of buyer shows up, it changes the floor under the market. And then there is silver, which plays a different game entirely. Gold is mainly a monetary metal. Silver lives in two worlds at once. Part of it behaves like money, and part of it behaves like a raw material the modern economy keeps chewing through. That second side is what makes silver dangerous in both directions. When growth fears hit, silver can look fragile because industry matters. But when the monetary bid returns while industrial demand stays firm, silver can move like it has been shot out of a slingshot. That is why it often lags first and then tries to steal the whole show later. Look around at how much silver hides inside the world now. Solar panels use it because it conducts electricity extremely well. Modern vehicles need more electronics than older ones. Data centers, defense systems, communications hardware, and advanced manufacturing all lean on it too. And supply does not respond cleanly. A lot of silver is produced as a byproduct when miners go after other metals. So even if the silver price rises, that does not instantly unlock a flood of new supply. You cannot turn on a silver faucet the way people casually imagine. If you want to catch the moment silver stops acting like the side character and starts acting like the scene thief, keep listening, because its delayed burst is one of the most misunderstood patterns in this whole space. People think silver is just gold, but cheaper. It is not. It is gold with an extra engine bolted underneath. Here's the framework I use to think through a crisis cycle in hard assets. Not 4 neat textbook chapters, but 4 emotional turns. The alarm, the shakeout, the handoff, the chase. The alarm is loud and dramatic. Prices spike. News breaks. Social media fills with maps and angry opinions, and everyone suddenly has a theory. This is when people buy because they are scared, not because they are prepared. That usually means bad entries and even worse expectations. Then comes the shakeout. This is the cruel middle. The war is still on the screen, but the market stops rewarding the obvious trade. Prices wobble, pull back, and exhaust everyone who expected instant validation. This stage feels personal because it attacks your confidence, not just your account. You start wondering if the whole idea was fake. You reread articles that once made you feel smart. Now they just make you feel late. That is exactly why this stage works. It forces weak conviction out into the open. It turns long-term logic into short-term pain, and it gets the public focused on what just happened instead of what pressure is quietly building next. After that comes the handoff. This is the part that is easy to miss because it rarely looks dramatic at first. The forced selling eases. The market stops falling on bad news with the same violence. Big buyers do not announce that moment with fireworks. They just start absorbing supply. A stronger hand begins taking metal from a weaker hand. The chart often still looks boring, which is why most people still do nothing. But boring is powerful in markets. Boring is where positions get built. Boring is where narratives change before headlines admit it. Boring is where money gets transferred from the impatient to the patient. If you are the kind of viewer who cares more about that quiet transfer than the loud panic before it, you already understand why people keep returning here. The biggest turns rarely begin with applause. They begin with doubt fading in slow motion. That is what makes them hard to spot and valuable to catch. Then comes the chase. This is when price finally starts doing what the public thought it would do at the beginning. Now the articles change tone. Now television brings on experts to explain the move after it already happened. Gold starts printing levels that once sounded unrealistic. Silver wakes up harder and later, and because it is a smaller market, the move can feel wild. Mining stocks suddenly look alive again. The people who sold in frustration start talking about waiting for a better entry. That better entry often never comes in the form they want. Maybe there's a dip, but it is shallower than they expected. Maybe the market pauses, but it pauses higher. The emotional damage from the shakeout keeps them frozen, while the thesis they abandoned keeps unfolding without them. This is why timing and psychology matter as much as macro theory. Being early feels like being wrong. Being patient feels like being punished. And if you do not understand the path, you can sabotage a correct idea before it pays. So what should people watch if they want to know whether the handoff is turning into the chase? Not every breaking news alert, not every dramatic statement from a politician, and not every price twitch in overnight trading. Watch the things that created the squeeze in the first place. If bond yields stop pressing higher, that matters. If the dollar loses its emergency strength, that matters. If gold stops dropping on bad headlines, that may matter even more. Also, watch relative behavior. When miners begin acting stronger than the metal, that can be a clue that traders are sniffing out better margins ahead. When silver stops underperforming and starts catching up fast, the market may be moving from caution into conviction. Price leadership often changes before the public story does. None of this gives you a magic date. Anyone promising the exact week of a major reversal is selling confidence, not certainty. But you do not need perfect timing to avoid the worst mistake. You just need a better map than the average person has. And the better map says this: the first reaction to crisis is often about money plumbing, not final meaning. It is about who needs cash, who wants yield, who trusts which currency, and how policy expectations get repriced. Later, the bigger question takes over. Can this debt-heavy system really solve inflation, conflict, and fiscal stress without weakening faith in paper promises? That is the question gold eventually answers. Silver answers it too, but in a more chaotic accent. Gold speaks first in the language of trust. Silver joins later in the language of trust plus scarcity inside the real economy. So the deeper issue is not whether hard assets can fall during a war. Of course they can. The deeper issue is whether that drop is a verdict or a passage. If it is a passage, then selling in disgust may become the costliest emotional decision of the cycle. There are usually two kinds of investors in moments like this. One type stares at the red screen and decides the market has exposed the whole story as nonsense. The other type asks a colder question: what if this pain is part of the sequence, not proof against it? The first type wants immediate emotional relief. The second type wants eventual clarity and better odds. The first type needs the market to agree with them quickly. The second type can survive being uncomfortable longer than the crowd. That difference sounds small, but it is enormous. Wealth is often built by people who can sit through the stage that makes everyone else feel foolish. Not because they enjoy pain, because they understand what the pain is for. So if gold and silver feel confusing right now, that feeling does not automatically mean you misunderstood the world. It may mean you are standing in the exact zone where weak narratives die, strong narratives get tested, and patient capital quietly takes inventory. That zone never feels heroic while you are inside it. It just feels unfair. But markets do not pay people for feeling right. They pay people for staying aligned with reality long enough for reality to become visible. And in hard asset cycles, visibility often arrives late. By the time it arrives, the easy entry is usually gone. If this kind of thinking helps you keep your head when prices try to steal it, that is the best reason to stay with this channel, because most people are not undone by bad information. They are undone by good information they cannot emotionally hold on to during the ugly middle. That is the part we keep trying to beat here. Not the market first, ourselves first. So here is the calm ending to a very noisy story. A crisis can push gold and silver down before it pushes them up. A safe haven can look unsafe before the system underneath it starts to wobble in plain sight. And the first drop can be less of a rejection than a toll you pay to stay in the trade. The people who understand that do not need every day to feel good. They need the sequence to make sense. Once it does, they stop asking why the chart betrayed them and start asking where the pressure is moving next. That is when they stop thinking like spectators and start thinking like owners, because the market's nastiest trick is simple. It makes the setup look weakest right before the reason for it gets stronger. And if you do not know that, you will hand over your position to someone who does. The loudest phase tests your nerves. The quiet phase tests your belief. The final phase rewards the people who learn the difference. And by then, the crowd usually calls it obvious. The move that changes your future rarely begins when it feels safe.